Everyone, my own personal welcome to this session of our Strategy Imagination Forum. As Ryan mentioned, I'm Sharon Matusik. I'm on the Strategic Management Society board. I'm also a longtime SMS member, a professor of strategy and entrepreneurship, and actually the dean at University of Colorado Boulder. And I'm very pleased to welcome you to today's session. What I'm going to do is just take a couple of minutes to talk a little bit about the goals of our Strategic Imagination Forums, do a brief introduction of Mr. Mackintosh, and then talk a little bit about the format of the session to get us up and started. So the Strategy Imagination Forums are an important component of what we're doing at Strategic Management Society to bring together those insights of our academic members with connection to the executive and practice audience out there. And so these forums are in their second year, and we feature speakers such as Mr. Mackintosh, who have very important insights to share that span both our academic as well as our executive and practitioner audiences. So we're thrilled to present this session to you today. Mr. Mackintosh needs no great introduction. He joined the Wall Street Journal in 2016 after about 20 years at the Financial Times, including being investment editor. He graduated from St. Catherine's College at Oxford, where he gained first-class degrees in philosophy and psychology. He also did postgraduate work at Oxford before moving over into the investment realm. He's a very highly respected voice in investments and markets, and much of his current commentary has been in the ESG area most recently. So with that said, what we're going to do this session, Mr. Mackintosh is going to present about 10 minutes worth of comments about his background, views, and perspectives on ESG, and then we'll go to moderated Q&A. So as Ryan mentioned, if you can share your questions either through the chat or the Q&A function, I will moderate that. I've got a few questions to kick us off once Mr. Mackintosh completes his initial comments, but we're really hoping to make this interactive, and so we invite all of you to submit your questions so that we can get to those and have this as more of a discussion. So with that said, thank you for joining us, Mr. Mackintosh, and please kick us off.
Thank you, Sharon. Thanks for the kind introduction. So delighted to be here. I have lots of problems with ESG, but I want to start really with just two of them to focus now, and then we can come back to other issues in the questions. But the two issues I would focus on are a logical problem and the issue of practicality. And I think the logical problem shows up one of the deepest flaws in ESG, and the problem is that of valuation, that the basic claim of ESG investing is that you can make more money, or at least the same money, and make the world a better place. And the trouble is that if you want to do that, you've got to take account of valuation. And ESG just doesn't. One way of thinking about that is if you're going to make more money from investing in stocks that are, I'll use some scare quotes, good on ESG, however you choose to measure that, that means they must be undervalued relative to their future prospects, or bad ESG companies must be overvalued. Sounds on the face of it quite plausible. Coal miners, if they're going to be stuck with stranded assets, oil companies with their oil fields that they're not allowed to extract, they're going to have some serious problems. And so maybe they're overvalued. That's the sort of very high level basic principle. The trouble is that a good company, if it's overpriced relative to its assets, no matter how good it is, if it's overpriced, that's a bad investment. So from an investment perspective, as opposed to how good a company is, this valuation is absolutely key. One example of this famous example outside of the ESG area, Coca-Cola, a fabulous company from an investment perspective normally, was trading at 50 times its earnings in 1998. And it won't surprise people who pay attention to valuation that 20 years later, in July 2018, after an incredible run of investing and at a great time for the stock market, the Coca-Cola share price was exactly the same as it was in 1998. He had made only the dividend, not a penny on the stock price. And that's simply because it was wildly overvalued. Its earnings were great, but just people thought its prospects were even better than they turned out to be. Now, could that turn out to be the case with ESG? Absolutely, it could. Maybe it will, maybe it won't. But the key is you've got to pay attention to that question when valuing ESG. So you should be saying, here's this threat. Maybe the world will move away from coal. No sign of it yet, but maybe the world will move away from coal. If the world's going to move away from coal, coal miners should be valued on the basis that they're not going to be able to extract all the coal from their coal mines. But whether that's a good investment or not depends on whether they already are valued like that. So someone who simply invests purely on ESG might say, well, I won't invest in those coal miners. And that's a fair enough approach. But they should accept that if it turns out that those coal miners are even cheaper than they should be on the basis that by 2030, 2040, 2050, pick your date, they'll be out of business. If that's going to be the case, then there's still some value in that stock, as long as it's not too leveraged. There's some value in that stock. And if the stock price is currently cheaper than that value, then there's money to be made in that. And so the logical flaw here is that you've got to bring in that valuation. And this has been, frankly, on display. Any ESG investor who bought a year ago, not ESG, but environmental investor who bought into clean energy stocks a year ago has seen them absolutely plummet in price, whilst coal stocks have soared in price, thanks to the actions of Putin invading Ukraine. But that is not, it's not a one-off exception to the ESG argument. It's absolutely fundamental to it that it fails to bring in this question of the trade-off between the prospects and what's currently priced in. And if you don't have that, you can't possibly expect that this will work out. It's just a finger in the air belief that somehow you'll make more money if you buy a good company. But you absolutely won't if you buy a good company that's already priced to be an amazing company. That isn't going to work out. So that's the fundamental logical flaw with the whole thing. Now, none of that is to say that ESG issues don't matter. It's clearly of vital importance, not just to coal companies, but to every company at a time when the world is changing on many, many respects, partly thanks to social media. But customers and workers care about a bunch of issues that they didn't really used to care about: carbon, biodiversity, equality, any number of issues that you can come up with that are listed in the ESG area. These things really do matter, and they really can matter to the stock price. Not necessarily, but they can matter to the stock price. And of course, that's what investors should do. That's investing. That's not ESG investing, it's just investing. Things that matter to the stock price, you should pay attention to. Investors who invest, there's this sort of myth out there that investors invest purely based on the profit and loss account and the balance sheet and the cash flow statement. And it is true, there are some investors who do quantitative modeling based exclusively on those things. But most investors pay attention to the stories around a company, the prospects, what the CEO says, what the customers say, what the staff say, because you don't want to invest in a company where half the workers are leaving because they can't bear to work for a nasty chief executive, where the products are outdated and no longer in demand. And as customers change their desires, maybe they'll continue to do that, and they'll want more low carbon products. They'll want more brands that exclude plastic or identify with biodiversity in some way, or promise more than minimum wage to their workers, these sorts of things. Now, if customers are willing to pay up for that, then that should be a more profitable company. Now, again, we come back to, if that's already in the stock price, there's no money to be made for an investor there, so you shouldn't expect to outperform if everyone's already recognized that. But you should pay attention to that, because you should know if you're paying for that or not as an investor. That's just investing. So to the extent that ESG does matter, and I think a lot of these issues hugely matter, not all of them, but a lot of them, then that's just investing. And that's how life is. And frankly, that's how life has always been. If you didn't pay attention to the way a company was run in the past, that was a recipe for losing money in Enron or any number of other badly managed, badly governed stocks. So there's a really important issue here. The problem is labeling it as ESG and investing according to ESG totally misleads the customers for what they get, because it doesn't both change the world and make more money. It either does one or the other. And I would say worse than that, when you come to the practicality questions, it often it doesn't help change the world much either. And part of the reason for that is that there's just no consistency in how we measure ESG. And I don't think there ever can be. There's a lot of pressure on, there's any number of pressure groups out there, and lots of governments trying to say we will find ways to even this out because they don't like the inconsistency between the measures of ESG. On one assessment says there's about a 40% correlation between a group of the most popular scoring systems for ESG. But in principle, these things are subjective. There's no sort of fundamental truth as to whether it's more important to assess the water use of a company or the carbon emissions or the way a company treats its workers. These aren't things that can be subject to some mathematical truth. It's a subjective question. How should you balance those things? And different scoring systems and different fund managers come up with different approaches. And indeed, different investors care about different things, the ones that are investing according to these things. And so again, this isn't a logical problem, it's a practical problem, but the practical problem of what is it that should be in ESG is one that can't ever be solved because we all care about different things. And that is a very serious problem with it. If we, of course, all care about the same thing in a democracy, we've got a very good way of dealing with that, which is that the government can legislate. And that actually has far more power and is a much better way of doing this. But maybe we can move on to that for the questions. But I think that, or maybe a couple of, narrow that down to a couple of very specific things. How would you balance the carbon emissions, a company that's great on carbon emissions, but terrible on how it's scored for treating its workforce? Tesla is an example there. Some of the scoring systems say that Tesla is great because its products are zero emission carbon by definition once they're sold. And they ignore the fact that the treatment of the workforce doesn't meet the highest standards, shall we say. And the governance is absolutely terrible, of course, dominated by Elon Musk, which doesn't meet any corporate governance standards. It works very well, but it doesn't meet corporate governance standards. Other companies say, well, actually, the governance matters more, the social issues matter more, and what we care about is the emissions from the factories, not from the vehicles. And the emissions from the factories and the supply chain are actually quite high because it's hard building a high-powered electric car, produces a lot of carbon emissions. So how do you balance those things? Well, everyone has different views and the different scoring systems have different views, and there just is no absolute truth to that. That makes it very difficult. And then one final point, which is really a political question, but if you believe that ESG does work and does change the world and ESG investing does have that effect, do you really think that in democracy it's the richest 10%, 20% that control the vast bulk of the country's investments that should make these decisions? Shouldn't this be a question that is down to government? And if the conclusion, and I hear this a lot from American ESG supporters, is that the government is the political system's fundamentally unable to cope with this, I think we might have deeper problems than ESG. Anyway, Sharon.
All right, I'm going to start us off with a few questions and would love for people to jump in with questions that they might have. One is just really building on some of your comments about the challenges of measuring ESG and how that relates to long run performance. And your perspective is, if these factors are indeed important, they should be evaluated by the market and built into the price. And you gave some great examples of competing elements associated with ESG. Can you reflect on whether you think market valuations are increasingly considering ESG factors? And if so, given the different categories within that broad umbrella, is the market valuing some higher than others? So you gave the example of the auto industry and Tesla. There's lots of interesting examples in your writings related to the energy industry. Can you comment a little bit on whether you are seeing market valuations reflect that more, and which dimensions seem to be most salient in those market valuations?
So on average, market valuations, well, it's very hard to tell because, again, it comes back to what do you use to measure it? So, should you use the scores from MSCI or from FTSE or from Sustainalytics? And if you use a different one, you get a different outcome, of course. If you use MSCI's scores, which are the ones that I think are most widely used, it's hard to be absolutely certain, but I think they're the most widely used ones. On MSCI's scores, there is a valuation premium for the stocks that it rates as better on ESG. The problem is that valuation premium's always been there, even before people cared about ESG very much. So all this flow of money into ESG and even into MSCI tracking, funds that track MSCI indexes of ESG, doesn't seem to have had an impact on the long run valuation. What there was in 2020 was a huge run up in some elements of ESG, in particular clean energy. There was a massive bubble in clean energy stocks. It was absolutely a bubble. There was no doubt about it. There was a rush to buy clean energy and anything connected with wind, solar, and various slightly more experimental areas saw a huge flood of investment, and their share prices went through the roof. Some of the hydrogen stocks did just phenomenally well, up by hundreds of percent. They were up there with some of the other bubbles of the time, the meme stocks, the cannabis stocks. And of course, Tesla was the absolute leading light in this in terms of size, incredibly popular. Since then, the vast bulk of those stocks have plummeted in price. Clean energy just had a terrible, terrible time. Even solid, rock solid company, or I say rock solid companies like Ørsted, which is the Danish wind turbine operator, former oil and gas company that converted into clean energy. It's had a terrible, terrible time. It's not because it's a bad company, although it has had some trouble with supply chains and so on. It's purely that it was in a bubble. Its price was way too high. So it came back down. Now, that doesn't mean it's a bad company. It doesn't mean clean energy is a stupid idea in any way. But clearly the people who piled into this stuff were doing so for classic bubble type reasons. It was going up very fast. There was this story around ESG and the environment that people believed in, and it didn't work out. And I think there's no real explanation except that people like buying stuff that goes up a lot and has a good story. I mean, this is the case of every bubble in history. But it became wildly out of whack with reality, and as a result has done very, very badly since. But it's very hard to pin down anything that says there's a real ESG premium for stocks in the long run. Partly because of measurement issues, what counts as a good ESG stock. I think partly because if there is a premium, it's probably overlaps with a whole bunch of other premiums. So the stocks that do well on ESG tend to be bigger because they're able to put in the effort to meet or to tick all the boxes to get a good score. They tend to be better quality in the sense that they tend to have less debt. They tend to have more reliable cash flows, these sorts of things. There's a big overlap there on these issues, and those are precisely the stocks that anyway would always have had a valuation premium. So the way I look at it is to look at what was the valuation premium over a long period of time. And if you look at it now-ish, and you look back 10 years, it's about the same. So you say, well, all these trillions that are now labeled as ESG don't seem to have changed, don't seem to have moved the needle a lot on valuation, which isn't particularly surprising when you think that if they were, you think about the amount of investors out there that are trying to correct valuations by picking stocks that are overpriced and shorting them, or picking stocks that are underpriced and buying them. Those people do a reasonably good job most of the time. So it's not particularly surprising there hasn't been a big pickup in valuation. And another way to look at it that's sort of slightly clearer is to look at the green bond market. Because in the green bond market, you literally have identical bonds that are labeled as green, that have the same, in every respect other than the fact they're labeled green, they're identical. So they have the same issuer, the same risk, and oftentimes the same coupon. So you can then say, well, if one is higher priced than the other, if one has a lower yield than the other, then that is what's known as a greenium in the green bond market. That's literally a premium valuation. And it does exist. People do overpay for these bonds. There's a deeper problem there that they don't change the world. They don't have any effect at all on the world. But people are willing to overpay for them in spite of that, just to get this label. And that's a separate issue, but an issue of another failure of ESG, in my view.
One of the other things that we're seeing more and more of is some extremely ambitious goals by chief executives of different organizations. And there's also been commentary that, these CEOs set these really ambitious goals, knowing that in 2030 or 2050, they're not going to be around to see whether those goals are actually achieved or not. Do you have a perspective on that and how the market is or isn't able to differentiate between kind of the symbolic value of setting very ambitious goals and the ability of an organization to realistically meet any of those goals?
I mean, it's clearly the case that some CEOs are doing precisely that. I think the market has done a reasonably good job at, or investors who care at least, have done a reasonably good job at saying what we should look at is not by 2050 we're going to be net zero or negative in some cases, but what's our progress plan towards that? And investors are used to CEOs setting out grand long-term targets. And the immediate first question of every investor when a CEO does that is, show me the milestones along the way. How will we know if you're on track? This is why quarterly results matter so much. It's not a short-termism problem. It's an issue of, are you on track towards that long-term goal? This is the only way we have to measure you. So there's lots of companies that have set out grand long-term targets and have set a whole series of intermediate targets along the way. And if you have that as your goal, that is absolutely what you should be doing. You need some way of measuring it. It can't, otherwise it's just wishful thinking. And by the way, it's not only companies that are doing that, governments are doing that too.
We have a question from Mark Scharfman. In 2008, we published a paper in SMJ that linked major environmental investment with reductions in cost of capital. A result in that study was that approximately 2 years after the investment, there was significant increases in stock price, which they attributed to reduced firm risk profiles. Now, 14 years later, would the market react the same way as investors seem to integrate ESG information more quickly?
So, I mean, it all depends on when. So in 2020, that was absolutely the case. If you announced a big green hydrogen project, your stock price soared. In 2021, that absolutely wasn't the case. And this year, it's also absolutely not the case. So I think that the problem with this is that for every study on this, there are studies showing the opposite as well. And a lot of this is just a question of timing. I mean, it depends. If investors perceive that green projects are going to be better, then obviously announcing a green project, are going to be very high cash flow, long-term reward projects, and also come with a whole bunch of side effects like making your workers more loyal and making your customers happier, and making your regulators happier, then of course those are going to be good things. If on the other hand, it's seen as the cost of doing business and just exactly what you've got to do, then it's not going to make any difference. And if you look at companies like Shell or BP, huge oil producers that have been investing very heavily in this, then for them, it hasn't worked out. I mean, Orsted, I gave the example earlier, obviously its transformation shows both these results. So it soared in value, not just in 2020, but it did incredibly well before that by transforming from an oil major into a very, very large wind farm installer. And it profited hugely from the, both in valuation terms and in earnings terms, from the world's shift towards wind farm, more and more wind farms, and the falling price of wind farms. And it did very well from that. And it's the, I think it's the world's number one for installing these. It's done very well. That hasn't helped it at all in the past 2 years. Its valuation's collapsed. So, what are the other factors that are going on? If the oil price is in the process of going up, you'd probably be better off in oil. If there's a global shortage of energy and you can't install wind farms very quickly, or connect them to the grid very quickly, get all the things that are barriers there, then actually maybe you're better off being in something that's extracting shale gas. So I think the problem with studies like that is that there are endless studies that show it in both directions. It's very hard to control for all these other factors.
Thank you. One of the listeners asks what type of feedback you've seen from your ESG columns.
So actually surprisingly positive. I expected that a lot of the ESG people, ESG promoters would be furious. I did a whole series of it, a whole series of these columns earlier this year on looking at lots of aspects of ESG. And I expected a lot of furious feedback from ESG supporters. And actually I got a lot of positive feedback from the people who are pro ESG. Partly because they can see that there's so much misunderstanding and so much misuse of it, and they want it to be properly understood and properly examined, and it just hasn't been, and that's a real problem. Now, obviously, there are, frankly, all of my columns, I get some furious rants from people, but there was much less of that than I expected.
Thank you. Due to some of the measurement challenges that you highlighted with regard to ESG, one of our listeners comments that it might become more difficult again to assess the performance of CEOs. Arbitrariness and ambiguity will be given more space again. This could strengthen the omnipotence of the CEO, as we saw before the shareholder value wave. What do you think about this?
Yeah, I mean, that it's certainly, it's been tried by CEOs, let's put it like that. So there was a recent case in France where activist investors forced out the CEO of Danone, who had been a huge promoter of ESG. And the claim of the activist investors was that he was covering up bad performance by talking about ESG issues. And actually, among the activists was one notable ESG investor who also believed that. So that may well be that might be true. It's hard to assess, right? But certainly CEOs are likely to try that. I mean, it's a sort of slightly orthogonal point, but it is connected, is that CEOs have been signing up to stakeholder capitalism as fast as they can. And of course, if the one of the core tenets of stakeholder capitalism is that the CEO gets to balance the difficult trade-offs between workers and shareholders and the environment and society, and therefore gets more power, and you get the omnipotent CEO again. But one of the against that, I would say, shareholder rights are pretty well entrenched, and the G bit of ESG, which tends to be ignored by most ESG investors most ESG marketing, let's say, ignores the G bit. But actually the G bit, most of the measures of that are traditional shareholder value type measures that want to put in place sensible controls and restrictions and independent directors and all of the other things that you would want as a shareholder, and in fact go rather against the rest of the E and the S.
So related to that, can you talk a little bit about good governance and the role of organizations that are very clear on what specific E or S goals they're achieving, and does transparency around that have a positive impact? So, for example, you listed many different kinds of examples of environmental and social goals, and someone in the chat has asked about DEI, diversity, equity, and inclusion also. Is there value in companies being very clear in terms of what specific goals they're going after and being transparent about success in those goals, rather than just being generally focused on ESG as a concept as opposed to more specific?
Yes. Very simply, yes. So again, this comes back not to ESG investing. I think companies should ignore ESG investing. They shouldn't care. What they should care about is ensuring that their core stakeholders are as happy as they can get. Not because I'm a believer in stakeholder capitalism, I should be clear, I absolutely not. But if you are trying to maximize shareholder value and your workforce is unhappy and your customers are unhappy, you're absolutely not going to maximize shareholder value. So the company should be focused on providing the products its customers want at the price they're willing to pay. And increasingly, the products the customers want at the price they're willing to pay requires some element of, at the very minimum, avoiding boycotts, because you've done bad stuff, which includes DEI and all the other issues. You've got to avoid getting a bad reputation. That's absolutely key to business and always has been key to business, but it matters more now because customers care more now than they used to about these issues. Workers, again, absolutely care more now, particularly if you're in a company with a lot of white collar workers. You'll find this really matters more than look at places like Google, Silicon Valley in general. You've seen a lot of workforce activism, and if you don't have any targets, you'll probably come under pressure from the workers to have targets. And if you have targets and miss them, you'll also come under pressure, but you're probably better able to set out and explain what's going on than if you just try to sweep the whole issue under the carpet. But again, it all comes down to who you are and what you do. So if you work in a business where the workers don't care, if you employ low-wage workers in China, it probably doesn't, from a workforce perspective, it probably isn't that big an issue. You've then got to manage other things. You've got to manage, do your customers care about the fact you've got a low-wage workforce in China? Well, as long as you're treating them well and doing as well you can, then that's probably all right. But these are issues that absolutely I think the company should care about, and care more about than it used to. But the reason they should care more about it is not ESG investing. It's because workers and customers care more about them than they used to.
Thank you. Do pro ESG shareholders, care about the historic patterns of firms' ESG performance?
So, to some extent, there is an investment model which says what we should do is buy, because they believe there's a valuation premium for ESG, because some people are willing to overpay for stocks. What you should do is buy companies that are bad on ESG and pressure them to become good on ESG, so they get the same valuation premium, and you'll make money as they go from being bad to good. And it's a classic activist strategy to try and change what a company does to improve its valuation, and it's just applied to ESG, and that's a plausible approach. One way of free riding on that is to say, well, we're not activists, we can't really do that, it's too difficult, we haven't got enough money, all of the problems that make activism difficult. And instead of that, you just look for companies that are improving their ESG scores and say, well, they're probably focused on getting a better ESG score. It's probably not just luck. So if we maybe we average it across a bunch of companies by buying lots of stocks that are getting better on ESG and hope that they continue getting better on ESG, and therefore cash in on that perceived premium for ESG. So that is a strategy that some companies follow. And to the extent that there's an ESG premium, and as I said, it's provable that there is one in green bonds, so there probably is in stocks as well, just much harder to measure in stocks. But that is a strategy that sort of looks at its past performance. I don't think people care about what the ESG score was 10 years ago, if that was what you mean. I don't think that matters.
Do you see much of a difference in terms of public versus private organizations and their attention to ESG? So, a lot of what you've talked about is the market discipline associated with publicly traded firms. Do you see much of a difference in terms of how private firms are approaching these concerns?
Yes, to put it mildly. So if you look at the strategy of a lot of public firms that are coming under pressure, the European oil majors are the clearest example of this. What they're doing is they're spinning off their sort of dirtiest operations, things that particularly European investors don't want them to own, and they're selling them. And in some cases, they're selling them to publicly traded companies that don't care, so US oil majors. In some cases, they're selling them to countries that don't care. So South Africa's coal mines, for example, were spun off into a South African listed company because South African investors are quite happy with that, because South Africa is totally reliant on coal for its electricity grid. So there was sort of no question that would be fine. But to a large extent, this stuff is being sold into private hands. The least socially acceptable stuff had already been sold like that. So Germany's coal mines, for example, which used to be owned by the Swedish state, weirdly, were sold to a Czech billionaire. Another Czech billionaire bought a large number of coal power plants in Europe. These are things that publicly traded companies don't want to touch European coal if they could possibly avoid it, because apart from anything else, it's a huge amount of hassle, but also because the government's made absolutely clear that it is going to clamp down on it. Although, again, they tended to spin it off at the wrong moment. They tended to sell it when it was cheap, and it then did better afterwards. But that's a separate issue. So yes, there has been a lot of private willingness to take risks, to take sort of reputational risks, let's say, in pursuit of money, and shouldn't really be a surprise that money is fungible, and there's a lot of people who don't care about ESG and are quite happy to profit from these things. But I do see that some of the big private equity funds, sometimes motivated by an assessment of the direction the world is going, and sometimes motivated by the fact that their biggest customers are huge pension funds, people like CalPERS, who are putting pressure on them, are tending away from fossil fuels in general. But there's plenty of other private money which has been willing to pick this stuff up when they see it trading at what they think is a discount.
Someone asks, who is the Warren Buffett of ESG investors?
That's very hard. There isn't a name that sticks out as being a. I mean, in a sense, it's the opposite. So Warren Buffett's, most famously known for his value approach, buying stuff cheap, and of course ESG absolutely doesn't do that. It buys stuff expensive. So it's hard to say there is anyone. I mean, in terms of the person who's made the single largest amount of money from clean energy, it's obviously Elon Musk. But I don't think I would equate Elon Musk with Warren Buffett. They're very, very different people, to put it mildly.
Do you see any lasting impact of the announcement that the Business Roundtable made back, just pre-pandemic, about the importance of stakeholders in general? I mean, was that just something that attracted attention to the ESG area and then kind of faded away? Or do you see any lasting impact in terms of their comments about stakeholders more broadly?
Well, I mean, I thought at the time that this was part of them trying to sort of deflect pressure, as it were, away from changes to corporate structures, which was a sort of possible outcome, and certainly seems to be sort of underway to some extent. But it came at a time when society is increasingly focused on a whole bunch of these issues, but it also and a whole bunch of sort of parallel things as well, like MMT theory and so these sorts of things that were hanging around at the same time. But I think the main issue is that they love the idea of being the arbiters of power. I mean, remember, the Business Roundtable is not really an association of businesses; it's an association of CEOs. And it's good for managers. Stakeholder capitalism puts more power in the hands of managers. So the question, if you're, I mean, it's quite ironic, really, but it's a sort of left wing project, stakeholder capitalism, and yet, or at least centre left, and yet ends up being a managerial issue that gives more power to some of the very richest people in society, who also choose to pay themselves huge amounts of money. And one thing that absolutely isn't on the table from this is that they will pay their workers more and pay their executives less. And you'll notice there was no mention of that. But that would be one of the obvious rebalances that one might say would benefit stakeholders. But the single biggest winners of stakeholder capitalism are people who aren't stakeholders at all, which are the CEOs.
Very interesting. So switching gears a little bit, you often lean against the wind, meaning that, in your positions on ESG, short-termism, inflation, other topic areas, you're kind of putting forth a contrarian perspective. Our audience today has many academics in it, and we regularly strive to make sure, as researchers and educators, that we're always entertaining the full scope of perspectives on important topics. And I'm wondering if you have advice on how we encourage more multi-sided discourse around important issues like those that you write about. And if you have any advice for business faculty on how we can better prepare our next generation of leaders to have that broader lens and making sure that they're considering all perspectives in their decision making.
Well, far be it from me to teach experienced educators how to educate, but I mean, I try to avoid being a controversialist for the sake of it, and I try to avoid being a contrarian for the sake of it. Sometimes I am deeply contrarian, and in markets, I mean, go back to Warren Buffett. It pays to be contrarian quite often. But if you're contrarian for the sake of it, it won't work out. So it's no good just, you've got to think through the issues deeply and work out what you think the truth is. And obviously I'm a journalist, so the things I publish have to be interesting, at least to some extent, as interesting as I could make them anyway. And, a contrarian view is more interesting. So one of the things I am always fighting against is the temptation to be contrarian for the sake of it, because whilst it's more interesting, you just end up being wrong a lot if you're always contrarian, because I would say in general markets are pretty efficient. They're pretty good. So from a purely markets perspective, that where my focus is writing my column, there are times when I'm contrarian, deeply contrarian. I'm screaming sell when the market's in a bubble, and I'm screaming buy when the market's in a slump. But you can't do that week in, week out, because you're just wrong most of the time, because most of the time the markets are right about things, or broadly right. So it's a difficult line to walk, to entertain the contrarian ideas, but most of the time dismiss them. And I would say that's the only lesson, is do consider the opposite case, and consider the logic behind what you're saying. In particular, when you find yourself thinking something that just doesn't make any sense, because everyone thinks it, and it's hard, it is hard to go against the crowd when that happens, but you have to have the confidence of your own convictions to do that. But you also have to double check that, is there some deep, you have to think about it more deeply before being different to the crowd.
And so related to that, do you have advice for CEOs who are listening in terms of how they also walk that line? So we talked about in the context of how educators can help our students and future leaders do that. So obviously CEOs are faced with many challenging decisions, particularly around balancing shareholder wealth and also ESG considerations. Do you have advice in terms of where you've seen people do an especially good job of balancing those different demands?
Well, I mean, the job of a CEO is to be a leader and to convince other people of their vision. And a CEO can't be consistently contrarian. They have to be sometimes contrarian, but they can't be too contrarian, because if they get too far away from what their shareholders want, they'll get fired. And if they set out to be convinced of something that the market is convinced of the opposite, they'll only be able to do that for a while before being proven wrong in the eyes of the market, and eventually fired. So if you want to be Elon Musk, who is, again, I come back to him just because, as a deeply contrarian, I mean, he set out to tackle some of the hardest problems in the world, but doing things people thought were impossible. I remember back in 2008, he was doing electric cars, or back in the mid 2000s when he was doing electric cars, and I was very closely following the car industry, because GM and Ford, of course, were having some serious problems, and he was out there doing this mad idea of putting together a whole bunch of Nokia batteries to power a car, and 20 years on, or not quite 15 years on, it's been phenomenally successful. He's built this incredible business against all the naysayers, but he was able to do that in large part partly because he had an incredible ability to lead and appeal to individual investors to back him, but also partly because he owns such a large chunk of the stock that no one could fire him. So there's the lesson there is, if you want to be really properly contrarian, you also need to be very rich. Do it with either your own money or with people who are absolutely confident in you and willing to do it. But mostly I would say it's about leadership. It's about being able to convince people of your story and convince enough of them that you're right, even though the wider market doesn't believe it. And as long as you've got enough behind you, you'll be able to get through the hard times. And you also, of course, eventually do need to be right in your contrarian take if you do that. So
Yeah. And just a follow-on question, so what should a CEO do today with regard to the drum of ESG proponents? Focusing on that stakeholder value and comparing that to shareholder value, if there is a lot of pressure around ESG, how does a CEO balance that?
So I would go back to, well, there's two aspects. One is what do they have to do to run a good business? And that means assessing how have things changed with regard to what their workforce cares about, what their customers care about, and what they're likely to care about over the next few years. And those, do involve far more focus on E&S issues than they did 10 years ago. And if the CEO is still living in the world of 10 years ago, then they should definitely be paying attention to that. On a purely cynical attempt to get some, valuation premium for ESG, they should engage with all the rating agencies, hire someone who's very good at getting around all the details of the rating agencies, and put in place a strategy to get a higher ESG score, which they can do at very minimal cost by ticking the right boxes. And that's totally cynical. They should be doing that as much as they can without changing their business model. And they can probably do it at very low cost. And I know of companies that have done this very successfully, and they can get their score up by just filling in the right forms. Immediately gets you a pickup, which is totally cynical, but they should do that. But should they change their whole business model? Well, you've got to assess if you're an oil company and you're saying, should I give up oil? Well, look at what your outlook is. Also, look at what the government's currently telling you to do, right? Look at what your customers are currently telling you to do. Everyone's screaming for more oil. They're subsidizing oil. The American government, supposedly committed to environmental goals, is browbeating shale oil producers to produce more oil because it's so worried about the cost of filling up a tank of gas. So I would say, this is an issue that you should be aware, absolutely closely following, and they all are obviously closely following what restrictions might come into place on your business because of politics around environmental issues and around social issues. And these are very important issues that are changing quite rapidly, and you should be aware of that and thinking about what to do. But should you be giving up oil and building wind farms instead, or returning money to shareholders instead, comes down to your assessment of where you think that politics is going to go. And remember, it might all go backwards. I mean, looking at the polls, it's not at all clear that the Democrats are going to be able to hold. I mean, it's quite plausible that a large number of Republicans who deny that there is such a thing as climate change will be elected in the midterms, and have a majority. And if that happens, the whole agenda changes again. So I think it does matter, but it's very hard to say this is a definite issue that they should be doing something about on a sort of grand scale. I would really hope that governments get their act together. I really want them to. But from a CEO perspective, you've got to make a realistic assessment of whether they will, not what you hope will happen.
We probably have time for one more question if anyone who's listening has another question they'd like to ask. It's a quiet audience right now. So I have one more question. I'm wondering if you have an updated perspective on where you think you're headed with inflation. So you've written a fair bit about what we should expect with inflation, and I don't know if you have any thoughts you'd like to share with us on changing gears a little bit away from ESG.
Yeah. So the latest forecasts are that inflation will be the rate, the monthly rate of inflation, as it were, will be down a little bit in the figures. It's Tuesday. It's Tuesday today, isn't it? I'm losing track of time. Yeah. So the figures are out tomorrow. Anyway, later this week, when the figures come out, the inflation should be down a little bit. But the the question of whether there's another spike, I mean, it's very hard. It's very hard to make sort of detailed short-term forecasts on this stuff. I would hope that this might be the peak. The markets have obviously been in turmoil as they flip between expecting an inflationary boom and an inflationary bust, stagflation, as it were. And if the Fed does indeed cause a deep recession, then of course inflation will come back down. In the long run, though, I think we have broken out of the cycle of disinflation that we've been in. So we've been in not just the 40 years since 1981 or so, where inflation had been coming down on a secular basis, but really the 10 years post 2008, where inflation was just super low all the time and consistently disappointing on the downside. I think it's much more likely now that there will be consistent upward inflationary pressure for at least a decade, maybe much longer, because of grand global changes. We're not getting again millions more new workers coming from China. In fact, quite the opposite. The population's actually shrinking. That was a huge demographic shock, which helped to lower global inflation. China was exporting deflation effectively, and that's not happening anymore. And then globalization, it seems to me, has peaked. I don't think I really hope we're not headed to very, very rapid deglobalization, but it's possible. There are some threats around that could make that happen, quite aside from Russia. But the general trend of deglobalization or slowbalization is a nice acronym, I've heard about that, should again mean more inflationary pressure, less disinflationary pressure coming from globalization. So these big trends, I think, will mean that it's harder for the central banks to, things that the central banks kind of took credit for in the last 30 years, 20 years, are things that aren't going to be continuing in future. And that's going to mean that the central banks are going to, instead of having a tailwind to their attempts to keep inflation low, are going to be fighting to keep inflation low, which doesn't mean I think we're getting continuation of 8% inflation all the time. This is clearly has a lot of supply side problems in it. But even once those supply side problems are resolved, I suspect we will be continuing to have upward pressure on inflation that makes it harder for the central banks.
Thank you very much for sharing your time and insights with us today, James. We really appreciate it. I hope everyone enjoyed the session. I'm going to turn it over to Ryan, who's going to have a few final comments on being able to access this recording in the future. Ryan, do you want to make a few closing remarks?
Yes, absolutely. Thank you both to James and Sharon for taking some time out of their day to do this. Thank all of you for watching. Yes, you can look us up on YouTube, the Strategic Management Society. I will, after we end this, I will process the recording. It'll be up on our website, strategicmanagement.net. You can also find us again on YouTube. And we will send out the link to everybody once it's ready. So thank you very much and enjoy the rest of your day.
Thank you,
everyone.